Welcome to Strategic Alternatives, the RBC Capital Markets podcast, where we uncover new ways to raise capital, drive growth, and create value in an ever-changing world with insights from our capital markets experts. In this episode, Amy Wu Silverman, Managing Director and Equity Derivatives Strategist at RBC, speaks with Anastasia Amoroso, Managing Director and Chief Investment Strategist at iCapital, on their Beyond 60/40 program. iCapital's Beyond 60/40 program brings you the latest market news and thought-provoking interviews with alternatives industry leaders. You can watch new episodes of Beyond 60/40 on iCapital.com. In today's discussion, Amy looks at how options can serve as leading indicators for markets, delves into the intricacies of volatility, and shares her insights on the themes investors should pursue and where they should consider hedging. Now let's dive in.
Well, there's so much that we can talk about here today because obviously there's a lot going on in the equity markets, rates markets, commodities, and of course your purview, which is the volatility and options market. So as you look across the volatility space, across options, what stands out to you?
There's so much to take in. There's so much to talk about. So maybe I'll just start 10,000 foot view. You know, from an options market perspective, I really think that post-COVID has been its own volatility regime. Yeah. And all the relationships that we kind of counted on in derivatives, they really broke apart. And I think you'll recall the GameStop frenzy, the AMC frenzy. You know, a lot of that bid for upside was a big part of it. And it's not just that. The AI frenzy is another part.
Yeah.
But one thing we have seen is option investors have really been focused on the right tail. They've really been focused on somehow getting upside as quickly as possible to the point where call demand is outweighing put demand. That doesn't normally happen. In 30 years of relationships, that's typically not inverted. We continue to see that inverted. The bid to the right side of the normal distribution to that tail was truly unprecedented. And I like to joke, it was the FOMO and the MOMO carrying you that you saw. And the one interesting thing I'll say now, Anastasia, is we are beginning to see an inflection point of worry, which we did not see before. But maybe it's a conglomeration of geopolitical risk, maybe it's the CPI prints, but we are starting to see the left tail wake up, the demand for hedging, and that has not been true the past 4 years.
All right. Yeah, you mentioned the word frenzy. And when I think back about the last 4 years, there's been a lot of episodes of frenzy, right? You mentioned the GameStop type stocks, and, you know, maybe you could argue there was a cryptocurrency frenzy, and, you know, now we have the AI frenzy. So there's been a lot of things to chase in the market. But you mentioned one thing, that the demand for calls has been outpacing the demand for puts. So what does that do for options pricing? Is buying upside participation that much more expensive?
Yeah, so certainly just very simply, upside participation is more expensive. But the other thing it does from a technical dynamic that we're very focused on, and this happened in something like a GameStop, it happened in something like an AMC, is the dealer on the other side also has to hedge what's going on. And that can also exacerbate upside because usually the way they hedge is they buy more shares. So we see these cycles of momentum, first of all. But the second thing I would say is if you want an analogy, it's sort of like investors are dipping their toe in the water, because I think for 4 years we were like, when is this recession coming? When is our hard landing coming? You know, consensus was just so unbelievably bearish. And we kept getting disappointed on the being bearish part. The market was just much stronger than we anticipated. And so how do you get upside really quickly? How do you get that right tail really quickly? We see it in that options demand, and that options demand often begets more options demand.
Right. Yeah, it's a really important point. And of course, if you're going to sit in a lot of cash, even if that cash is parked in a money market, and yet the market is up, 20, 30, 40%, depending on what you look at, that was the case last year, how do you quickly get exposure? Of course, has been through the upside participation. So how do you square this chase in the market and this in the equities market, options market, for upside versus not actually seeing that materialize in sort of cash instruments?
Yeah, that's really interesting because I think what the options market is doing is it's sort of a leading indicator. The second thing I would say is people like to call it FOMO, but momentum itself is a factor, right? So the idea that when you start to see things do well and you haven't participated and you started to lag your benchmark, you need to participate, and that obviously exacerbates the upside. So one thing we have seen over and over and over post-2020 is when you start to see these large concentration of stocks do well, whether because of AI or simply it's the Mag 7 concentration running, you start to see that bid to the tail get higher and higher and higher because people are starting to say to themselves, hey, I've been consensus bearish. I've been worried about this recession that hasn't happened. I've been worried about this hard landing. And meanwhile, all these stocks I haven't participated in are running. I need to get exposure to that quickly. We often see that in the options market.
Yeah. Speaking of the bearish side of things, do you think investors are right to be looking for more downside protection, or have we already seen the implied volatility for put options spike to where it doesn't make sense to chase that?
I think it's definitely not too late. So when you kind of look at the implied volatility, that cost of protection, on a 5-year basis, on a 10-year basis, on a 15-year basis, we're really still at historic lows. And you've seen investors express it very simply, something just like S&P puts, but you've also seen upside in the energy sector, for instance. You've seen upside in gold from options. And I think these are all variations on a theme. So whether it's a variation on the geopolitical theme, which is where it would lead you to energy, or inflation concern, which would lead you to gold, or overall market concern, which would lead you just simply to the market itself, we're starting to see that worry pick up. But again, on a historical basis, very, very cheap, because the focus has all been the right tail.
As you look across sectors and factors today, what do you think you should be chasing, or what do you think you should be hedging?
One sector that we're focused on is semiconductors. And the reason is because when you kind of go back to the history of the chase, if you will, when the AI frenzy first started, it really started with NVIDIA initially did their first earnings about May of last year. And when that chase happened, it was really just in NVIDIA itself. It really contributed to this narrowness of breadth in the market. But as that stock continues to go up and up and up, investors have started to ask themselves, how are we on this valuation? Are we too full? What are the adjacent names?
Can't be just one company.
Can't just be just one company if this is meant to be a secular theme that's going to drive the market for years and years. And so obviously semiconductors have had a run, don't get me wrong, but we continue to see that adjacent demand. And although that haul demand is obviously expensive, again, historically, it can go much higher if you use NVIDIA as a proxy to where that momentum begets momentum.
Right. So we've had a lot of momentum in semiconductors. The likes of NVIDIA were up close to 200% or more last year. So far this year, semiconductors are up about 14%, close to that. So, is it still really a sector that investors should feel comfortable chasing? And if so, is there an effective way to do that in the options market?
Yeah, so I'll say two things about that. The first is, one of the indicators that we use to specifically answer this question is this idea of skew inversion. So basically the idea that this call demand is outweighing this put demand, but where are we on a percentile basis? Could this go higher? Can this go more extreme? Because we've seen that in things like AI names like NVIDIA. We've seen that in names like GameStop and AMC. So that indicator is telling us that yes, there's positive momentum, but we think that momentum,
meaning the difference in implied volatility
between those calls and those puts.
Right. Exactly. And the call leg potentially becoming that much more extreme.
Yep, exactly right. And, when we measure that on a percentile basis, is it richer? Yes. But do we think we can actually hit higher percentiles based on what we've seen happen in other outliers that have experienced this frenzy, experienced this bid? The answer is yes. And, I will tell you, I continue to speak with investors, institutions, hedge funds that I speak to who are still looking for these skew inverted names. They're still asking us what's the best trades to express this on something like semis. They're still digging, and they're still basically hoping that this breadth widens of the market to something other than just a handful of AI names.
Right. It seems like the options pricing and sort of the secular fundamental reason to own semiconductors are really aligning quite nicely. And when I think about, what is likely to drive demand for semiconductors beyond NVIDIA, it's because this is not a several quarters, trend. This is a multi-year build out of the artificial intelligence infrastructure. And I think what started as this, demand for compute, demand for GPUs that clearly benefited NVIDIA is now likely to broaden out to, investors thinking, well, what's the infrastructure that's needed?
Yeah.
And, you're not doing that AI crunching most likely, in a server on premise. You're doing that in the data center. And, you need interconnectivity between data centers and, to various parts where you might actually finally need that output and need the data. So the common linkage between that, you need all sorts of semiconductors. You need compute, you need storage, you need memory, you need networking, you need 5G equipment. So that's what I really like about this broadening out of the semiconductor theme as a way to participate in the secular trend of artificial intelligence.
Yeah, look, like Jamie Dimon says, it's sort of like the initial invention of the steam engine, right? Like it's sort of almost a wave of innovation that's going to really touch every point.
Is groundbreaking, and there's a ways to go, and there's a way to effectively position for that in the options market.
Yeah, that's exactly right. So one thing, we're looking for that not only in options, but is also with a partnership RBC is doing with Solactive, which looks at semiconductors. We also have one for blue chip stocks. One thing we like is the balance of high quality company balance sheets versus low quality balance sheets. But look, I think those two things, interestingly, wasn't driven by us ourselves. It was driven by client end demand, because I think people are quite aware of this. But again, they want that breadth. They don't want it to just be one name or two names. And I think you're really seeing that expression through the demand that we're seeing incoming.
Thanks for listening to Strategic Alternatives, the RBC Capital Markets podcast. Remember to subscribe to the podcast to stay up to date on all our future episodes. This episode was recorded on April 18th, 2024. If you'd like more information or to continue the conversation, please contact your RBC representative or visit rbccm.com/strategic alternatives. See you next time.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.